Most traders lose money before the trade even begins. Not because they misread the chart, but because they can't wait for confirmation. Livermore noticed this over a century ago. Amateurs jump in on the first sign of movement, and professionals wait for the second. Here's the brutal truth. Your first signal is almost always a trap. The second is the test. That's the difference between impulse and execution, between the dreamer and the operator. Picture this. A stock breaks a key level. Volume spikes. Your heart races. Every cell in your body says, "This is it, get in now." And that exact voice is why most traders never grow an account past 4 digits. That first breakout is the bait. Livermore tracked hundreds of trades like this. He noticed that strong moves give a tell, a small hesitation, a pullback, and then a second push. That second push is where the professionals step in, not the first. Why? Because the market uses the first move to shake out the undisciplined. The second move reveals true intent. It confirms strength. It confirms pressure. It confirms that the pivot wasn't noise, it was real. This is the seed of the 2x confirmation signal. But we're not ready to define it yet. Not fully. Not until you understand the psychology behind why waiting even 30 seconds feels like losing control. And that's where the amateurs fold. The professional sees waiting as a position, because here's the paradox Livermore lived by. The best trades start with boredom, not excitement. And before we define the exact steps of the 2x confirmation signal, you need one more shift. You must understand why the market gives you 2 chances, and why taking the first is almost always premature. We'll open that loop in Chapter 2, where the real mechanics begin. Amateurs enter on the first signal. Professionals wait for the second. Livermore understood that breakouts often lure traders in with excitement, volume spikes, emotion spikes, and suddenly, the trader feels like waiting is dangerous. But the market almost always gives 2 chances. A first move that acts like bait, and a second move that reveals the true trend. Professionals don't fear waiting. They view waiting as part of the position, a deliberate choice that filters noise from true commitment. This chapter seeds the mystery of the 2x confirmation signal, but intentionally withholds the exact procedure, priming the viewer to move into Chapter 2. The goal is to break the amateur impulse, introduce the paradox that the best trades feel boring at first, and create a psychological setup for learning the precise method. The chapter closes with a cliffhanger. Why does the market offer 2 chances? And why is the first almost always premature? That loop propels attention into the next chapter. Think about your last impulsive trade and where it began. You felt a rush and treated movement as permission. But the market doesn't hand out permission, it tests intent. Livermore's edge was simple. He treated the first move as a mechanical operation, not a promise. He let the market prove itself twice before he committed capital. Every experienced trader understands that price action speaks in 2 voices. The initial scream and the later whisper that becomes a sustained sentence. The first scream attracts attention. The second whisper contains meaning. When price screams, the inexperienced flock. When the whisper follows, the experienced act. This is not mystical. It is behavioral. Humans are wired to respond to change. Our amygdala mistakes volatility for opportunity and danger at the same time. We feel like winners when we act fast, even if we lose later. Losses that occur from early entries are often small in price but large in effect on confidence. You can recover $15 easily. You rarely recover the pattern of doubting your process. That psychological wound compounds across trades. Every premature entry teaches you false lessons about control and luck. Waiting, on the other hand, trains a different muscle. It trains patience, observation, and acceptance. These are the muscles of professionals. They are the reason a professional can look at a 10% drawdown and remain unshaken. Now imagine the market as a stage and the first move as an audition. Everyone shows up to the audition and yells their lines. The market applauds a few and lets many leave empty-handed. The second act is quieter. It reveals who can sustain the scene. That second act is the second pivot. It is not always dramatic. Sometimes it is an inch of price and a small rise in volume. Sometimes it is the tape going silent, and then someone stepping in silently with accumulation. Recognizing the second pivot takes practice and a rule set. You can't rely on feelings here. You must define the structure you look for in advance. That structure is your stop loss, your position size, and your definition of confirmation. Your rule might say, enter when the price reclaims the breakout high on higher than average volume, or enter when the pullback holds above the breakout level and the tape shows steady buying prints. Specificity reduces negotiation. When your rule is clear, you don't argue with the market. You act or you don't. Acting becomes a mechanical function of evidence, not emotion. That shift from emotion to evidence is the professional leap. Livermore didn't trust sentiment. He trusted structures and probabilities. He built his rules around observable market behavior, not wishful thinking. He wrote down what a successful confirmation would look like and followed it without exception. This doesn't mean you will never be wrong. It means you will be wrong with a plan and a known cost. To trade with the 2x confirmation signal, you must accept small, intentional losses as the price of being right more often. That acceptance is what separates the operator from the gambler. Operators design tests, gamblers chase thrills. When you treat waiting as a position, you change how you breathe during the trade. You stop viewing time as wasted and see it as information accruing. Each minute that passes without a failure is evidence in your favor. Each failed test is a gift. It kept your capital intact for a better opportunity. Now let's talk about the technical elements you will watch during that pause after the first pivot. Volume behavior is the first tell. A healthy pullback usually shows volume contraction, not expansion. If volume expands on the pullback, that suggests heavier selling or distribution. That is a warning sign, not a minor issue. Price staying above the breakout level is the next structural check. If the breakout level holds as support, the market is respecting the structure. If it fails, the signal has no integrity. The tape is the final nuance you study. Look for steady prints, consistent sizes, and lack of large aggressive offers that push price through your level. Those details separate the textbook from the real world. An aggressive offer or a giant block sale can invalidate the setup even if other boxes check out. Your protocol must include what to do in those edge cases. For example, if the pullback holds, but the tape shows heavy distribution prints, you might wait for an additional reclaim or step back entirely. Your rule should have an abort condition as plainly as the entry condition. That reduces hesitation if the trade turns ugly. Discipline without structure is just stubbornness. Structure without discipline is just rules on paper. You need both. Finally, recognize the human cost of being early. It's not just money, it's attention. Attention is a finite resource in a trader's day. Every premature trade taxes that attention, making the next decision worse. When you conserve attention by waiting, you are investing in better future choices. This is why professionals often trade fewer setups but make more from each. The market rewards quality, not quantity. One clean 2x confirmed entry can outperform 10 frantic attempts. Start thinking in terms of information asymmetry. When you act only after confirmation, you trade with better information than the crowd that jumped early. That's the core of an edge. Thanks for watching, and subscribe to this life to my ness. Edge is not being cleverest. It's being better informed when you commit. As you practice the 2x confirmation signal, keep a journal that records each first pivot, the pullback behavior, your thought process, and whether the second pivot delivered. Journaling forces you to confront patterns that emotion will obscure. You'll notice that your early entries often follow the same mental scripts. You'll see how certain stocks and sectors are more prone to false breakouts. You'll learn which tape behaviors you consistently misread. That learning curve shortens as you accumulate disciplined weights. In the next chapter, we will dissect several real-world examples and walk step by step through the checks and abort conditions you must use. We will also formalize a simple checklist you can apply in real time. But for now, close this loop. The market gives two chances because it needs to, and because it can. It tests both price and you, and the operator who waits tests back. Here are three practical maxims to anchor you now. 1. Size first, conviction second. Start with a fraction of your intended size on the second pivot and only increase as the market repeatedly validates the move. 2. Your stop must live on structure, not sentiment. Placing your stop under the pullback low makes cost predictable and keeps emotion out of the exit decision. 3. Pyramiding is permissioned by proof. Only add when your evidence set expands. Higher highs on volume, cleaner tape, and new participants stepping in. Repeat those maxims until they become automatic. Practice builds procedural memory, which beats willpower in the pressure moments. Now a short tactical checklist you can hold in your head while the market is noisy. 1. Identify breakout level and mark it. 2. Watch the first pivot and note where volume peaked. 3. Observe the pullback. Did volume contract? 4. Does price respect the breakout level? 5. Watch the tape for steady buying prints. 6. Enter when price reclaims the first pivot high on renewed strength. 7. Place stop under pullback low. 8. Add incrementally on confirmed follow-through. Memorize the checklist like a pilot memorizes a pre-flight routine. It is not glamorous, but it keeps planes in the air. Finally, accept that the market will sometimes refuse to behave. Sometimes the second pivot never comes, and you must let the idea go without regret. That is a professional skill, knowing when to walk away. Every abandoned setup preserves capital and attention for the next true opportunity. Livermore said, "Money follows correct behavior more reliably than prediction." And that is the essence of the 2x confirmation habit. To close this passage, remember the opening paradox. The best trades start with boredom, not excitement. Train yourself to find calm in the pause. Find curiosity in boring tape. Let the market show you proof twice and respond as the operator you intend to become. In Chapter 2, we will map this logic into specific chart patterns and live examples so you can see the 2x confirmation signal in action and practice it without risking capital. Until then, treat waiting as a position and let the market earn your trust. Trade deliberately. To continue expanding the logic of the 2x confirmation signal, we need to sit inside the psychology of the first pivot long enough to feel its traps, because the first pivot isn't merely a chart event, it's a psychological stress test disguised as opportunity. When a stock surges through a level everyone has been watching, it feels like a moment you must act on immediately. The tape speeds up, momentum appears genuine, and every instinct tells you that hesitation equals loss. This is the mental pressure cooker that produces impulsive trades. The amateur sees the first burst as proof. The professional sees it as a question. This distinction is not philosophical. It is practical. It is the difference between feeding liquidity and harvesting it. Livermore learned early that the first breakout is the market's invitation to misinterpret emotional noise as structural intent. The first move is flashy, but flash is rarely foundation. It's the market clearing tension, flushing weak hands, shaking out indecision, and revealing nothing yet about real direction. The amateur reacts to motion. The professional reacts to information. Those two responses differ completely. Motion is seductive. Information is quieter. When the first pivot erupts, the amateur sees the motion, green bars, big prints, a surge in volume, and assumes these are signs of commitment. But the professional sees context. He asks whether that surge is coming from genuine accumulation or simply the unwinding of trapped positions. A breakout caused by shorts scrambling to cover is not the same as a breakout caused by funds building size. One can exhaust itself in minutes. The other fuels a trend for days or weeks. The skilled operator is not concerned with the excitement of the first move. He is concerned with the quality of participants behind it. And quality cannot be judged on speed. It must be judged on how price behaves when the pressure of the first thrust subsides. This is why he approached the first pivot as a question. not an invitation. His notes repeatedly emphasize, watch first, break carefully, seldom act. A first pivot is the market clearing noise, not the market declaring intent. It's the moment where structural pressure gets released, but structural direction has not yet begun. The truth is that most first pivots are simply the market relieving tension built up around a key level. Traders positioned on the wrong side are forced out. Stops are triggered. Latent orders that have been waiting get processed. This activity creates motion, but motion is not meaning. The professional waits for meaning, and meaning appears only when the market has finished digesting the first burst and begins to show whether it wants to continue or reverse. That digestion process is the pullback, the pause, the quiet moment that reveals more truth than the breakout itself. When the first pivot pulls back, the amateur misreads the moment entirely. He believes the move has failed. He believes he is now too late. He believes the stock is teasing him. All of these beliefs stem from impatience, and impatience is the most expensive trait a trader can have. Livermore learned through ruin that impatience forces a trader into the wrong position at the exact wrong time. The first pivot punishes those who think trading is about catching movement. Professionals, in contrast, welcome the pause that follows the first pivot because it tells them whether the move was emotional or intentional. The pullback is not a reversal, it is a test. Every meaningful trend must be tested before it can advance. The professionals know the market never confirms direction on the first push. That pause is the first half of the 2x confirmation signal, and without studying it, no trader can enter with confidence. This is the essence of the 2x confirmation signal. The first pivot is only half the story. The pullback, the pause, the hesitation, the restful moment where price breathes, is the hinge around which the signal turns. If that pullback shows weakness, the first pivot was a head fake. If the pullback shows strength, the market is loading the second pivot. That second pivot, when it arrives, is the moment of true commitment, the moment where the market demonstrates that real buying or selling power is stepping in. The first pivot is noise. The pause is information. The second pivot is intent. When you begin to see the market this way, the first pivot stops being a temptation and becomes a diagnostic tool. You observe without reacting. You evaluate without participating. You wait because you understand that waiting is the only way to distinguish possibility from confirmation. Amateurs often wonder why they keep entering early and getting stopped out just before the real move begins. They are trading the first pivot instead of waiting for the second. They mistake potential for confirmation. They mistake motion for direction. They mistake reaction for intention. Livermore structured his entire methodology around avoiding this mistake. He believed that the market always gives a second chance, and anyone who enters on the first pivot is willfully choosing difficulty. The irony is that the first pivot feels like the safest place to enter because it is the loudest, the most dramatic, the most emotional. But those qualities are precisely why it is so dangerous. The market rewards calm interpretation, not frantic participation. The second pivot is not for those seeking excitement. It is for those seeking accuracy. When you observe the pullback after the first pivot, you are observing the market's character. Weak pullbacks are shallow, controlled, quiet. The tape shows thoughtful buyers lifting offers without urgency. Price stays elevated without dramatic reversals. The entire structure communicates a readiness to continue. Strong pullbacks, in contrast, crash quickly back through the breakout level, flushing weak-handed participants and invalidating the move. The tape feels panicked. Volume stays elevated, and the sense of exhaustion is palpable. A professional does not predict which kind of pullback will occur. He observes it. The market tells him whether the first pivot mattered. This approach removes ego from the process. You no longer need to be right about the breakout. You simply need to be prepared to act when the second pivot confirms the truth. The patience required to wait through this process is what most traders lack. They want clarity in the first minute, but the first minute is a lie. The market does not reveal truth through speed. It reveals truth through endurance. Watching the tape slow down after the first pivot is part of the process. Seeing the stock test the breakout level without collapsing builds confidence. Observing volume quietly contract shows absorption rather than rejection. These are the internal signals that prepare a trader for the second pivot. When the second pivot fires, the trade no longer feels impulsive. It feels inevitable. This emotional shift is crucial. Trades entered on the second pivot allow the trader to hold with conviction because the setup is built on structural strength rather than emotional momentum. The more you study historical charts, the more obvious this pattern becomes. Almost every meaningful move contains a first pivot that looks irresistible and a second pivot that actually works. Livermore developed the habit of mentally discarding the first pivot entirely. He didn't assign value to it beyond observation. He used it to gather information, not to take action. This separation between observation and action is one of the hardest skills to develop. Most traders blur the two and treat observation as permission. Professionals treat observation as preparation. The first pivot prepares them. The second pivot positions them. Even more critical is what happens internally during the pause. When price pulls back after the first pivot, both amateurs and professionals feel tension, but they respond differently. The amateur sees the pullback as a loss of opportunity and feels anxiety. The professional sees the pullback as the formation of opportunity and feels calm attention. One is driven by fear of missing out. The other is driven by desire for confirmation. This internal split is what separates consistent profitability from chronic frustration. Learning to experience the pullback without emotional disturbance is the first step toward trading mastery. The pause also reveals liquidity dynamics. During the pullback, if large players were behind the first pivot, they often continue accumulating quietly. Their prints are small, distributed, and intentionally non-disruptive. They want the price to hold, not to surge yet. This quiet accumulation is one of the most powerful signs of a healthy setup. When the second pivot triggers, it is these players who explode into action. They are the ones who convert hesitation into momentum. The second pivot is their declaration that the real move has begun. Another misconception amateurs have is thinking the first pivot is where smart money enters. In reality, smart money often initiates before the breakout and confirms after the first pivot, not during it. They understand the mechanics of crowd behavior. They know that the breakout line is where amateurs will chase and professionals will wait. By waiting for the second pivot, they gain clarity about who controls the tape. They avoid the emotional minefield of the first move and position themselves only when the market reveals its true participants. This structural discipline is why Livermore's notes repeatedly emphasize that the professional fears being early far more than being late. Early entries can lead to immediate losses, forced exits, and psychological damage. Slightly late entries, after confirmation, allow the trader to ride the real trend without noise. The difference between early and slightly late is the difference between gambling and strategy. The second pivot ensures that you are engaging only when there is proof, not hope. By treating the first pivot as a diagnostic moment instead of an invitation, you align yourself with the way the best operators trade. You also remove unnecessary randomness from your decision-making. The first pivot becomes information. The second pivot becomes opportunity. This is the mental shift that transforms erratic traders into consistent ones. The discipline of waiting reshapes your identity. You stop seeking excitement and start seeking confirmation. You stop trying to predict and start trying to verify. This is how the 2x confirmation signal becomes more than a tactic. It becomes a worldview. This chapter's purpose is to cement that identity shift. You must lose your addiction to the first move. You must embrace the idea that the market gives rewards to those who allow it to speak twice. The second pivot is not merely a better entry, it is the only rational entry. The first pivot exists to test your emotional stability. The second pivot exists to reward your discipline. And when you integrate this truth into your trading, The chaos of the market begins to feel ordered. You see structure where you used to see noise. You recognize intent where you used to see randomness. The entire practice becomes slower, calmer, clearer. The irony is that once you internalize this, trading becomes far simpler than it appears. You no longer feel compelled to act on every fluctuation or every burst of volatility. Instead, you understand that the market will always reveal its true hand, and it will do so through the repetition of behavior rather than the drama of a single moment. This gives you permission to slow down, to observe, to think clearly. The second pivot becomes your anchor. The moment you choose precision instead of panic, discipline instead of impulse, structure instead of chaos. This clarity is what truly separates winners from crowds. Extra words. Now we're ready for the heart of the method, the moment Livermore waited for while the tape tempted everyone else into early entries. The second pivot is where he built his fortune, and it's shockingly simple but brutally difficult without discipline. The 2x confirmation signal is built on one principle. Price must prove itself twice. Not once, twice. Once on the initial breakout, and once more when it resumes strength after the pullback. That is the rule that separates amateurs from professionals, impulsive gamblers from operators who systematically harvest opportunity. Think about that for a moment. Every first pivot can feel irresistible, yet almost always, it is only half the story. The second pivot, however, is where clarity emerges. The first pivot hints at possibility. The second pivot confirms intent. And this confirmation is not subtle. It is decisive, measurable, and reliable, but only if you have the patience to wait for it. Here's the exact protocol, step by step. Step 1. Identify the first pivot. This is your breakout above a meaningful resistance level, or your breakdown below a support level. It is the first burst of movement that attracts attention, triggers stop orders, and excites amateurs into premature action. Step 2. Wait for the pullback. Do not rush. Price must pause or retreat slightly. This is where you evaluate three key elements: volume, tape tone, and structural integrity of the level itself. You are not guessing. You are observing. Observe whether volume contracts during the pullback, which is ideal. Observe whether price respects the breakout or breakdown level, holding it as support or resistance. And observe the tape hesitation rather than rejection indicates that the market is preparing the stage for the second push. Step 3. Enter only when the second push triggers. When price reclaims momentum and moves past the high of the first pivot, that's your green light. That is the moment of clarity, when the market has revealed genuine buying or selling pressure, and the amateurs who rushed in first have exhausted themselves or been shaken out. The second pivot is where real money sits because it is confirmed by structural behavior, not impulse. To understand this in action, consider a simple story. A trader sees a stock break over $100 and acts immediately. The stock dips to $98. Panic sets in. The amateur loses confidence and either sells at a loss or doubles down without structure. The professional, however, waits. He watches the dip, observes volume dry up, and notes that the price does not violate the breakout level. Then he sees price push back toward $100 and eventually through $101. That is the second pivot. That is the entry point where clarity and confidence converge. Position size can now be defined rationally. Stop-loss placement is meaningful because structural levels are verified. This is not luck. This is process. And the psychological contrast is stark. The amateur trades fear. The professional trades evidence. Livermore's genius was not only in identifying the second pivot, but in using it as a foundation for pyramiding. A second push was not merely an entry, it was a confirmation that the trend had structural integrity. Once confirmed, he could scale, press, and build a position incrementally. But even then, he did not size aggressively. Discipline dictated that even confirmed entries start small and expand only as evidence increased. This is a maxim to internalize. The second push is the real push. It is the pulse of the market, the moment where probability is on your side and emotion is controlled. Entering earlier often produces the same motion, but without the structural clarity that guarantees confidence in holding a position. Waiting for the second pivot is waiting for proof. Acting before the proof is gambling. The 2x confirmation signal also formalizes decision-making. It transforms observation into action and eliminates ambiguity. The amateur is plagued by the question, "Did I miss it?" The professional is guided by observation. Price has confirmed. I act. The first pivot provides context. The pullback provides data. The second pivot provides the actionable signal. This sequence is the essence of structured trading. If you skip any step, you compromise probability and open yourself to the emotional chaos of impulsive trading. Consider that almost every failed breakout is a first pivot gone wrong. Amateurs entered too early. Stops were hit. Capital was lost. Confidence eroded. The second pivot, by contrast, is a controlled entry point that reduces both risk and cognitive load. The difference is behavior, not prediction. Volume is the first key element to watch during the pullback. Healthy pullbacks display volume contraction. This suggests that selling pressure is dissipating and that the initial breakout was not fully absorbed by frantic traders. If volume expands on the pullback, it signals heavier selling and potential invalidation. Price behavior relative to the breakout level is the second element. If the breakout level holds as support or resistance in the case of a breakdown, the structure is validated. If it fails, the setup is compromised. Finally, tape tone is the subtle but critical third element. Hesitation prints, small orders absorbed without disruption, and steady accumulation indicate the market is preparing a genuine move. Rejection prints, spikes in aggressive offers, and volatile swings suggest amateurs dominate the action, and the move is likely to fail. The disciplined operator combines these three elements to know precisely when to act. The second pivot also informs risk management. Because the entry is confirmed, position size can be calculated based on known stop-loss levels, defined by the pullback, low, or high, in the case of a short. Pyramiding becomes a structured exercise rather than an emotional gamble. Incremental additions are based on verified movement, not hope. This preserves capital while enhancing potential returns. The second pivot is the moment of alignment. Evidence, risk, and opportunity converge. Livermore's journals are filled with examples where adherence to this rule produced outsized results. One of his key observations: money flows toward discipline, not impulse. Entering on the second pivot is discipline rewarded. The psychological edge of the second pivot is just as important as the mechanical edge. By waiting, the professional develops calm observation under pressure. The first pivot might excite or terrify, but the second pivot offers clarity and reduces stress. The operator's attention is focused, not scattered. Emotional interference diminishes, and decisions are made rationally. This is why the second pivot is not only a technical construct, but a behavioral one. It trains the mind to separate observation from action, to treat patience as an active part of strategy. Traders who master this routinely outperform those who chase the first move because they are not reactive, they are deliberate. The market rewards deliberation more than it rewards speed. Another subtle aspect of the second pivot is crowd dynamics. The first pivot flushes weak hands. The second pivot reveals who is committed. Large participants, funds, and informed traders rarely enter on the first spike. They wait for confirmation. When the second pivot occurs, it is often accompanied by measured volume, indicative of real structural buying or selling. Observing these dynamics is crucial. Professionals align with these participants, entering after validation rather than before. This ensures they are trading with the flow of real market intention, rather than against transient noise. Acting before the second pivot is often trading against the market, entering while amateurs are being shaken out. Acting after the second pivot is trading with the market, entering alongside participants who drive genuine trends. The 2x confirmation signal also eliminates the mental torment of FOMO. By codifying the second pivot as the proper entry, the operator no longer frets over missing the first move. Missed opportunities are no longer losses in perception, they are data points. The market will give a second chance. Acting on confirmation ensures that every entry has a rational basis. This behavioral change is as important as the technical mechanics because it preserves both capital and attention. Repeated adherence to the rule builds procedural memory. Over time, the trader reacts automatically to evidence, not emotion, and consistently enters higher probability setups. This is the essence of operational discipline. Livermore's strategy also emphasizes clarity of maxim. Never guess. Observe, evaluate, and act on confirmation. The market is generous in repetition but ruthless to impatience. The second pivot is where intention becomes visible, structure becomes reliable, and probability favors the operator. Pyramiding after the second pivot is structured expansion, not opportunistic greed. Entry, stop loss, and scale are all governed by verified evidence. By adhering to this, a trader builds size and confidence simultaneously. The phrase, "the second push is the real push," encapsulates the philosophy. The first move is audition, the second move is commitment. As you practice this, remember that the second pivot is both psychological and mechanical. It is a moment of mental calm where observation is rewarded and action is rationalized. It is a discipline test that the market administers continuously. By integrating this into your process, you trade fewer, higher quality setups, and preserve attention and capital. The difference between acting early and acting on confirmation can be the difference between repeated small losses and exponential gains. Professionals understand this. Amateurs struggle to accept it. The 2x confirmation signal is a bridge from impulsive behavior to structured execution. In closing, consider this final procedural checklist for the 2x confirmation signal. First, identify the breakout or breakdown level, the first pivot. Second, observe the pullback, noting volume, price behavior, and tape tone. Third, enter when the second pivot occurs, when momentum resumes and surpasses the first pivot's extreme. Fourth, define stop loss based on structural levels. Fifth, pyramid incrementally as the move confirms. Repeat this method consistently. Do not act on the first pivot. Treat waiting as a position. Let the market prove itself twice before committing. This simple rule, rigorously applied, is the difference between impulsive traders and disciplined operators, between losses and compounding success. By respecting the structure of the second pivot, you align behavior with probability, patience with opportunity, and execution with evidence. Summary: the second pivot is the centerpiece of the 2x confirmation signal and the source of Livermore's greatest edge. Unlike amateurs who react to the first pivot, professionals wait for confirmation, observing pullback behavior, volume, tape, and structural integrity. The method is simple in theory but psychologically demanding. Wait through the first move, observe the pause, then act decisively on the second push. This approach allows for rational entry, structured stop-loss placement, and pyramiding with confidence. By codifying patience as a functional part of strategy, the operator transforms observation into action and reduces emotional interference. The second pivot distinguishes impulsive trades from deliberate execution. It clarifies market intent, aligns with high-probability participants, and mitigates fear of missing out. Traders who master this consistently outperform those who chase first-move excitement. Procedural adherence, not prediction, becomes the operational advantage. The 2x confirmation signal bridges psychology and mechanics. The first pivot is audition. The second pivot is commitment. Apply it consistently, respect its sequence, and trade with precision, patience, and discipline. Now we enter the intersection of signal and risk, the place where many traders fail because they mistake confirmation for certainty. A signal alone does not guarantee safety. He does not guarantee safety. He does not guarantee. Even Livermore, who built a fortune on precise observation, treated the 2x confirmation signal as permission, not certainty. Professionals know that confirmation merely grants entry, not immunity. Amateurs, by contrast, read confirmation as assurance, as though the market has promised them a winning trade. This subtle distinction is lethal. The professional respects the market's capacity to invalidate even perfect setups. The amateur negotiates with losses and eventually pays the price. Every trading account blow-up you've ever heard of begins with misunderstanding this principle. Risk exists whether the chart looks perfect or chaotic. Respecting it is what allows professionals to survive drawdowns, scale size, and compound gains over time. The first element of risk management with the 2x confirmation signal is position size. Start small. Livermore often initiated his trades on the second pivot with exploratory size, typically around 25% of the intended full position. This is critical. The second pivot confirms the move, but it does not guarantee trend integrity. By entering modestly, you maintain flexibility. Your account can absorb noise, you retain psychological control, and you create room to pyramid if strength proves itself. Amateurs often do the opposite. They commit maximum capital on the first pivot or the early surge of the second pivot. They are all in before the market has fully revealed itself. When the inevitable pullback or small retracement occurs, they are trapped. There is no room to add, no space to adjust, no freedom to trade with flow. The professional knows that incremental exposure is the path to longevity. Small entries do not dilute opportunity, they amplify survivability. Stop-loss placement is the second pillar. A clean stop-loss is structural, not emotional. For long setups, it sits beneath the pullback low. For shorts, it sits above the pullback high. This transforms risk from an abstract fear into a defined, actionable boundary. The market dictates whether the setup remains valid. If price violates the stop, the signal has failed. Accept it immediately and without argument. Professionals cut decisively. Amateurs hesitate, rationalize, and cling to hope. Observing the pullback before entry is what makes this stop meaningful. It is not arbitrary. It is the structural marker that preserves capital. Without it, any trade, no matter how strong the setup looks, becomes gambling. Stop losses aligned with the 2x confirmation signal ensure that trades are risk-defined, not ego-driven. Pyramiding is where professional trading transforms potential into scale. Once the second pivot has been established and the initial position is in place, the professional looks for incremental confirmations to add size. Livermore's method is methodical. Enter small at the second pivot, then add again once price moves 2-4% in your favor. Further additions occur when subsequent logical pivots confirm trend strength. Each layer of the pyramid is predicated on new evidence, never on hope. This sequence ensures that exposure grows only as certainty increases. You are never betting big on uncertainty. You bet bigger only on strength. This creates a compounding advantage. Capital is preserved during noise, while full conviction is applied only when the market has repeatedly proven its intent. The amateur, by contrast, often enters large early, leaving no room to scale and no mechanism to take advantage of validated trends. This is why pyramiding is not just a tactic, it is a mindset. I pay more because now I know more becomes the professional's mantra, capturing the essence of evidence-driven sizing. Consider the psychological implications. A trader who jumps early, overcommits, and faces a pullback experiences fear, anxiety, and regret simultaneously. He is stuck in the trade, unable to add or adjust without increasing risk irrationally. There is no flexibility, no room for structured pyramiding, and no clarity. Compare this to the professional who waits for the second pivot. He may pay a slightly higher price, but he enters with flow, alignment, and psychological freedom. Each incremental add becomes a decision based on market confirmation, not impulse. The emotional state is calmer, decisions are clearer, and the ability to execute with precision increases dramatically. This is the core of the identity shift that Livermore emphasized. Trading is not about speed or being first. It is about acting in concert with structural confirmation and using risk intelligently. Integration of the 2x confirmation signal with risk management also extends to the handling of multiple positions. Professionals understand that the first entry is never maximal. They maintain capital reserves, scale as evidence appears, and define exits in relation to structural pivots. Amateurs, in contrast, often risk entire positions on a single setup, amplifying vulnerability to drawdowns and emotional interference. The disciplined operator leverages partial entries and pyramiding to manage exposure dynamically. This approach increases the probability of compounding success while simultaneously controlling maximum risk. The combination of defined stop-loss placement, exploratory position sizing, and structured pyramiding is the professional's toolkit for consistently turning confirmation into performance. Stop-loss discipline cannot be overstated. When tied to the structural low of the pullback, the stop functions as an objective arbiter. The second pivot has provided confirmation, but the market always retains the ability to invalidate setups. By accepting losses promptly and structurally, the professional preserves capital, psychological clarity, and the ability to participate in future trades. Amateurs often ignore stops, allowing hope to dictate decisions. This is fatal. Confirmation signals without disciplined risk control are like a high-performance engine without brakes. Momentum exists, but there is no protection from catastrophe. The sequence of events becomes procedural. Identify the second pivot, enter with an exploratory position, place a stop beneath the pullback low, observe price progression, and add incrementally as strength confirms itself. Every action is tied to evidence, not conjecture. This disciplined framework removes the randomness and emotion that plague inexperienced traders. By structuring trade management around both confirmation and risk, the operator maintains control in chaotic markets and amplifies gains in verified trends. This is why professional trading is often described as boring to the amateur. The steps are deliberate, methodical, and driven by repeated confirmation. Excitement is neither sought nor needed. Results come from adherence to process. Many stories illustrate the contrast sharply. Consider a trader who jumps early on the first pivot with maximum size. The stock dips. Panic ensues. He cannot add. He cannot reduce exposure rationally. Every decision becomes emotionally charged. The professional, entering on the second pivot, pays slightly more, yes, but enters alongside confirmed market pressure. Incremental adds are available as the trend proves itself. Flexibility exists. Clarity exists. Risk is defined and contained. Psychological freedom is preserved. Over time, this disciplined methodology compounds both capital and confidence. The second pivot becomes the entry. Structured pyramiding becomes the engine for growth. Risk management becomes the safeguard that ensures longevity. The professional mindset here is critical. Never assume certainty, never bet maximal size prematurely, and never let emotion dictate your decisions. The 2x confirmation signal is a tool for precision, but precision without risk control is incomplete. By integrating position sizing, stop-loss discipline, and pyramiding into the second pivot, the trader achieves alignment between market structure and capital allocation. Risk is quantified, exposure is managed, and the market dictates the pace of commitment. Evidence drives action. Emotion is secondary. This is the psychological transformation that separates operators from amateurs. The first pivot may excite, but the second pivot, combined with disciplined risk, empowers. Consider scaling in practice. Enter 25% of intended exposure on the second pivot. Price moves 4% favorably. Add another 25%. Price confirms at the next logical pivot. Add a further 25% or 30%. Stop losses are adjusted if necessary to lock in structure. By the end of the sequence, the position is fully built, but every layer was earned through structural confirmation, not hope. Risk remains defined at each step. This is leverage under control, a professional maxim, not an aspiration. The amateur, by contrast, has no such structured path. They either enter too big initially or never scale effectively, leaving gains incomplete or exposing themselves to unnecessary drawdowns. By combining the 2x confirmation signal with structured position sizing, disciplined stop-loss placement, and incremental pyramiding, the operator transforms trading from impulsive reaction into procedural execution. Each decision is guided by observable evidence, rather than fear, hope, or greed. This sequence creates both mechanical and psychological edges. Mechanical in the sense of objective entry, stop and scale, and psychological in the sense of emotional freedom, clarity, and confidence. Long-term performance stems from this integration. Professionals survive, amateurs do not. The market rewards consistency and discipline over impulse. In summary, the 2x confirmation signal is not merely about identifying entries. It is a framework for managing risk and building positions intelligently. Signals provide opportunity, but risk management ensures longevity. Professionals enter small, stop cleanly, and add incrementally as evidence accrues. Amateurs enter early, overcommit, and leave themselves psychologically and financially exposed. The professional mindset crystallizes into a single aphorism: I pay more because now I know more. This philosophy, applied rigorously, ensures that confirmation translates into structured, controlled, and scalable trades, bridging signal recognition with operational discipline, and creating the foundation for enduring success. Summary: the 2x confirmation signal is inseparable from disciplined risk management. Professionals treat confirmation as permission, not certainty, integrating it with exploratory position sizing, structural stop-loss placement, and controlled pyramiding. Starting small allows flexibility, observing pullbacks preserves clarity, and incremental adds reward confirmed strength. Amateurs enter early and overcommit, often losing flexibility, clarity, and capital. By entering at the second pivot with proper risk parameters, the trader aligns with market intent while preserving psychological freedom. Stop losses are based on structural levels, not emotion, and pyramiding is executed only after repeated confirmation. Livermore's maxim, I pay more because now I know more, encapsulates the mindset. The chapter demonstrates that the 2x confirmation signal is not merely a technical method, but a discipline framework, blending execution, risk, and psychology into a coherent approach that professionals use to survive, scale, and compound gains systematically. The 2x confirmation signal is more than a chart pattern or entry rule, it is an identity test. Every time you wait for the second pivot, the market is asking a profound question. Am I trading the market, or is the market trading me? Livermore asked himself this daily, and the answer defined his discipline, his capital preservation, and ultimately, his success. Most traders can read charts. Most can identify breakouts and breakdowns. But few can tolerate the silence, the pause, the emptiness between pivots. This is where amateurs fail. They see movement and assume inaction is risk. Their minds conflate waiting with weakness. Professionals understand that waiting is not absence of action, it is a deliberate position. Every second spent observing, every moment resisting impulse, is part of executing the trade correctly. Waiting is how you trade from strength, not survival. This is the psychological pivot of the 2x confirmation signal. Consider what happens when the first pivot occurs. Price breaks through a key level. Volume spikes. Your heart races. Every instinct screams to act. Amateurs oblige, jumping in because action equals control. Professionals pause. They observe the pullback. They watch volume, tape, and price behavior. They let the market reveal itself again. The first pivot is the test of emotion. Can you resist excitement? Can you ignore the fear of missing out? The second pivot is the test of discipline. Only by passing both can you act with confidence and clarity. Waiting is your position. Every second you refrain from impulsive entry, You align with market structure and probability. This is a fundamental lesson. The professional operates from alignment, the amateur from impulse. Livermore described waiting as positioning. It is counterintuitive because the amateur mind equates success with speed, with instant action. Yet in trading, moving too early almost always increases risk and reduces probability. Waiting filters noise. It avoids emotional trades. It prevents early losses that can damage confidence. And it ensures that your entry occurs only when the market's pressure aligns with structural integrity. In essence, patience becomes a tool, not a test of courage. It is a method of ensuring that the market validates the trade before capital is committed. The second pivot is not just a chart signal. It is a psychological confirmation that you are operating from discipline rather than impulse. Imagine a trader observing a breakout. The tape is alive, volume is surging, and the first pivot tempts immediate action. His hands shake. His mind whispers, "This is it. Jump in now." But he waits. Price pulls back slightly, testing the previous breakout level. He feels foolish. He questions his discipline. Then, as if on cue, price retests the high and breaks through cleanly. The entry is boring, almost uneventful, yet it is precise, controlled, and decisive. This is the professional's entry. Quiet, aligned, and confident. The difference between amateurs and professionals is stark. One acts out of fear of missing out. The other acts because the market has earned the trade. This principle can be distilled into a maxim. The best trades feel like drifting into a current, not forcing, not chasing, not reacting to excitement, aligning. Alignment, not speed, drives the professional edge. The market will offer two chances for a reason. The first tests your emotional impulse. The second tests your discipline. Miss the first, and you learn patience. Fail the second, and you learn humility. Pass both, and you trade with conviction. This is the identity filter embedded in the 2x confirmation signal. It is not merely about price. It is about who you are as a trader. The 2x confirmation signal divides traders into two categories: those who need excitement and those who need clarity. You cannot be both. If you chase excitement, you will always enter too early, be shaken out by minor noise, and compound stress rather than capital. If you seek clarity, you align with structure, wait for confirmation, and enter with evidence, not emotion. The amateur is impatient. The professional is deliberate. The amateur reacts. The professional observes. Discipline becomes identity. This is why the signal is as much a psychological tool as a technical one. Traders who internalize this principle operate in a different state of mind. They are calm, decisive, and confident because their actions are aligned with market validation, not impulse. There is also a feedback loop that reinforces discipline. Every successful trade, executed after the second pivot, reinforces patience, strengthens confidence in observation, and trains the mind to respect structure. Every premature entry that fails reinforces the cost of acting on emotion. Over time, adherence to the 2x confirmation signal instills a professional trading identity. You begin to measure yourself not by how fast you act, but by how correctly you act. Waiting is no longer uncomfortable. It is the strategic choice that differentiates operators from amateurs. This identity shift is subtle but profound. Trading becomes less about reacting and more about understanding, less about excitement and more about evidence. Livermore's journals consistently reflect this mindset. He emphasized that the first pivot is almost always bait. It excites, it tempts, it exposes emotion. The second pivot is where true intent is revealed both in price and in the trader. By waiting, you align with the market's structural truth. By observing, you gather evidence. By acting on the second pivot, you execute with confidence and control. This sequence transforms trades into lessons, entries into affirmations of discipline, and charts into a mirror reflecting trader identity. The 2x confirmation signal is therefore both a mechanical and psychological system. It integrates price, probability, and patience into a coherent framework. Let's revisit the psychological dimension with another example. A trader watches a breakout at $120. First pivot triggers. Volume spikes. Every instinct screams to act. He waits. Price dips to $118, testing support. He feels anxious. Doubts creep in. He could have entered at the first spike, but restraint wins. Price retests $120 and breaks $121, decisively the second pivot. The entry feels mundane, almost anticlimactic, yet it is the correct moment. Risk is defined, structure is intact, and confidence is preserved. This is how the professional consistently positions themselves for success. Not by reacting to excitement, but by waiting for structural clarity and market alignment. The second pivot, therefore, confirms not only price strength, but trader discipline. The practical takeaway is that the 2x confirmation signal shapes an entire trading identity. Waiting is not procrastination, it is a strategic stance. Acting only on confirmation is not hesitation, it is evidence-based execution. The market tests emotions first, discipline second. Only the disciplined survive. The professional trader internalizes this rhythm. Identify the first pivot, observe the pullback, confirm the second pivot, enter with evidence, and manage risk. Every trade executed in this manner reinforces the identity of a trader who acts deliberately, patiently, and consistently. This framework extends beyond individual trades. It defines how one approaches markets, risk, and self-control. In closing, consider the lessons we've drawn from the 2x confirmation signal. The market gives two chances. The first tests your emotional impulse. The second tests your discipline. The professional waits. The amateur jumps. Waiting is positioning. Acting on confirmation is execution. Risk is respected. Structure is honored. And clarity is prioritized over excitement. This is how discipline is cultivated. Identity is formed. And capital is preserved. The market is neutral. It rewards those who trade with process, rather than emotion. The 2x confirmation signal is therefore both a technical method and a philosophical framework, a tool to navigate the market, and a test of self. Master it, and you begin to trade not just for profit, but as an operator in alignment with evidence, structure, and your own disciplined identity. Summary. The 2x confirmation signal transcends technical entry rules to become a framework for professional trading identity. Waiting for the second pivot is a deliberate form of positioning that separates amateurs from operators. The first pivot tests emotion. The second pivot tests discipline. Professionals enter only after evidence aligns with market structure, preserving capital, clarity, and flexibility. This approach fosters psychological resilience, reinforces patience, and ensures that every trade is executed deliberately rather than impulsively. By internalizing this process, traders transition from excitement-driven behavior to clarity-driven execution. The method cultivates a disciplined mindset, transforms observation into action, and aligns trading behavior with market validation. Adherence to the second pivot not only improves mechanical execution but also shapes trader identity, bridging strategy and psychology, and ensuring only the disciplined survive.